Hello class, and welcome to the video lecture for corporations. Learning Unit 3 is about journalizing capital stock transactions and calculating dividends. Let's go over the first example in the textbook at the bottom of page 657. Roger Company sells 200 shares of a $10 par value common stock at $10 per share on February 3rd. This is also called issuing common stock. The company sells 200 shares for $10 each, so that's $2,000 in cash that the company receives. We debit cash for $2,000. By issuing the stock, owner's equity is increased. Remember that common stock is a general ledger account in the equity section of the balance sheet. An increase in equity is done with a credit, and we credit the number of shares issued multiplied by the par value of the stock. In this case, the par value is $10, so we credit $2,000. In the next example, Roger Company sells 300 shares of $50 par value preferred stock at $50. Just like the previous example, we debit cash for the amount of cash received, which is the number of shares issued multiplied by the price. The price in this case is $50 per share, so we debit cash for $15,000. Also like the previous example, we increase equity with a credit, but in this case we credit the general ledger account called preferred stock. In the next example, Roger Company sells 50 shares of $10 par value common stock at $15. In this case, the stock is sold for more than its par value, which is called a premium. The premium is recorded in an equity account called paid-in capital in excess of par value. This is a general ledger account, just like common stock, with a normal credit balance, and is listed in the paid-in capital section of the balance sheet. So let's analyze this transaction. Roger sold 50 shares. The par value of each share is $10. The company sold the shares for $15 each. Notice the wording here where it says at $15. This means it sold the shares for that price. We determine the cash by multiplying the number of shares sold by the price. We have 50 shares multiplied by the price of $15 per share, which is $750. So we debit cash for $750. Next, we credit the common stock account, but only for the par value, not any of the premium. To find the par value, we multiply the number of shares sold by the par value, so that's 50 times 10, which is $500. The rest, $250, the premium, is credited to the account paid in capital in excess of par value. The next example doesn't happen very often, so I won't spend much time on it. Roger Company sells 100 shares of $10 par value common stock at $8. When a stock is sold below par, a discount on stock results. An account called discount on common stock, which is a contra equity account, is used to record the difference between the price and the par value. In the next example, Moss Company sells 300 shares of no par common stock for $20. Again, the amount of cash received is the number of shares sold multiplied by the price, which is $6,000. Since this stock has no par value, we use the price sold as the par value, so we credit $6,000. Now we have Reese Company, which sells 200 shares of no par common stock with a stated value of $40 for $50 per share. In the last learning unit, I pointed out there's no difference in the accounting treatment of stock that has a stated value instead of a par value. This transaction is recorded in the same way. To find the cash, we multiply the number of shares sold, which is 200, by the price per share, which is 50, for a total of $10,000. The amount credited to common stock in this case is the number of shares sold multiplied by the stated value of $40, which is $8,000. The premium, which is the amount paid above the stated value, is credited to the paid-in capital in excess of stated value account. Finally, we have an example in which stock is traded for assets other than cash. On July 8th, Moss Corporation exchanged 3,000 shares of $10 par value common stock for machinery, buildings, and land. The assets had fair market values of $5,000, $10,000, and $20,000 respectively. In this case, we debit the asset accounts machinery, buildings, and land instead of cash. We still credit common stock by the number of shares sold by the par value per share, which is 3,000 times 10 for a total of $30,000. The difference between the value of the assets received and the total par value of the stock sold is the amount credited to paid-in capital in excess of par. Okay, now we're going to switch gears a little bit and we're going to start calculating dividends. 4 steps are involved in calculating dividends. Remember in the last learning unit, I said you needed to learn the different types of dividends? Here's where you need to know those types. First, we calculate dividends that go to preferred stockholders. Remember, preferred stockholders get dividends first. Next, if there's any dividends left, calculate the dividends that go to common stockholders. If there's still dividends left to allocate, go to step 3. Step 3 depends upon whether the preferred stock is participating or not. If it's non-participating, skip this step. If it is participating, you will find the total par value of each type of stock of all stock issued. The final step is to allocate the remaining dividend based on a ratio. Let's go through an example. We have the following facts. A $150,000 dividend has been declared by the Board of Directors. Our job is to allocate this amount to the stockholders. We have 1,000 shares of preferred stock with a par value of $200 per share. The preferred stock is participating at 6%. This is the language used to describe participating preferred stock. We also have 6,000 shares of common stock, par value of $100 per share. The first step is to calculate the amount of dividend that goes to the preferred stockholders. To find this amount, multiply the number of shares times the par value per share by the percentage given. And you see here the result is $12,000. Since our total dividend is $150,000 and we've only allocated $12,000, we continue on to step 2. Step 2 is to calculate the dividend to common stockholders. We do this the same way we did for the participating preferred stockholders. Multiply the number of shares times the par value per share by the percentage, and we arrive at $36,000. Okay, the third step is to determine the total par value of preferred stock and common stock in order to determine a ratio to split up the remaining dividend. Total par value is determined by multiplying the total number of preferred shares by the par value per share, which is 200,000, and adding to that number, the number of common shares multiplied by the par value per share, which is 600,000. This means we have a total par value of $800,000. The final step is to perform the calculation using a ratio on the remaining amount of dividends to distribute. How much do we have to distribute? If we started out with $150,000 and we already allocated $12,000 in step 1 and $36,000 in step 2, that means we have $102,000 left to distribute. If the preferred stock has a total par value of $200,000 out of a grand total of $800,000, then the ratio is 200,000 divided by 800,000. We multiply that ratio by the amount left to distribute, and we would arrive at 25,500. The remaining dividend is allocated to common stockholders. So let's do a problem from the textbook. I'd like to do problem 18B-2 on page 677. It says, Dixon Corporation has 23,500 shares outstanding of $14 par value, 10% preferred stock, and 47,000 shares outstanding of $14 par value common stock. In its first 5 years of operations, the company paid the following dividends. In 2011, 0. In 2012, 32,900. 2013, they paid 98,700. 2014, 0. 2015, 151,000. It says calculate the dividends paid to preferred and common stockholders under the following 3 independent situations. Okay, so I have the information here so I can keep it clear of the screen that I'm going to write on. So A, the preferred stock is non-cumulative and non-participating. So 2011, we have just going to make a little chart here, preferred and common. In 2011, no dividends were paid to anyone. Okay, and the preferred stock is non-cumulative, so that means that even though they didn't get paid this year, it doesn't hold over to the next year, so nobody gets anything in 2011. Okay, in 2012, we have 32,900 in dividends to pay. So we start with step 1 and determine the dividends to preferred stockholders. And we do this by multiplying the number of shares times the par value per share times the percentage. So I'm going to do some little calculations down here. So we have 23,500, that's our number of preferred shares, times the par value of the preferred shares, which is 14, times the percentage, which is 10%. If you work that out in your calculator, you get 32,900. So preferred stockholders get $32,900. Okay, at this point, we determine if we can move on to step 2. So do we have any more dividends to distribute? We don't, because we only started out with 32,900. So in 2012, the common stockholders don't get any dividends. Okay, 2013. We have 98,700 dividends to pay. So again, we start with step 1 and determine the dividends to preferred stockholders. The calculation is the same as it was in 2012. So 32,000, again 32,900 is given to the preferred stockholders. We still have dividends left to distribute, so we can move on to step number 2. Step 2 is to determine the dividends to the common stockholders. And we do this by multiplying the number of shares times the par value per share times the percentage. So for common stockholders, it's 47,000 times the par value of 14. They both have the same par value. That's just coincidence. Times 10%, and that is 65,800. Okay, so at this point we determine if we move on to step 3. So do we have any more dividends to distribute? So far, let me just put this up, 65,800. Okay, so can we move to step 3? So we've given 32,900 to the preferred stockholders. We've given 65,800 to the common stockholders, and that just so happens to equal 98,700. So we've given out all our money, so we have no more to give out. So that's the end of that. Okay, so let's move to 2014. 2014, no dividends. Nobody gets anything that year. Okay, 2015. Now in 2015, we have $151,000 of dividends to pay. We already calculated the amounts for excuse me, for steps 1 and step 2 in the previous years. So we know that 32,900 goes to the preferred stockholders, and 65,800 goes to the common stockholders. So, just got to turn page here in my notes. Excuse me just a moment. So, do we have any left? Yes, we do. We have we have 151,000 to give out. We've already allocated 32,900, and we allocated another 65,800. So how much do we have left? We have 52,300. Okay, so at this point we move to step 3, which is to determine which is to determine the par value of preferred and common stock if the preferred stock is participating. Okay, in this situation, the preferred stock is non-participating. So all of the remaining dividends go to common stockholders. So not only do they get this, they also get the 52,300. So in 2015, preferred stockholders get 32,900, and the common stockholders get the sum of these two numbers, which happens to be 118,100. Okay, so that's the first scenario. I don't want to get rid of some of these calculations, so I'm just going to erase some of this. Bear with me here. Okay, so we have situation number 2. The preferred stock is cumulative and non-participating. Okay, 2011. The company didn't declare any dividends. So no dividends went to preferred or common stockholders. However, the preferred stock is cumulative. The dividend to which the preferred stockholders had a right needs to be accounted for. We call these dividends in arrears. Dividends in arrears. Okay. So the company doesn't have anything to give them. However, the preferred stockholders are cumulative, so they'll be getting this amount next year, the $32,900. Dividends and arrears aren't entered into any accounting records, but you need to keep track of them. Oops. Okay, so let's move on to 2012. In 2012, we have $32,900 in dividends to pay. So the very first thing that happens is that preferred stockholders are paid dividends in arrears, which is $32,900. So we haven't even started any of our steps yet, and we're already getting the preferred stockholders caught up. But now we don't have anything left, and once again we need to account for the dividends in which the preferred stockholders have a right in 2012. So once again, this $32,900 becomes dividends in arrears. Okay, so, and common stockholders don't get anything. 2013, we have $98,700 dividends to pay. So first, we pay the dividends in arrears to the preferred stockholders before we even do anything else. Okay, so how much do we have left? We have, let's see, we started out with $98,700. We're taking care of our dividends and arrears, so we have $65,800 left. I'm just going to clean this up a little bit here, make some more room. Okay, so now we start with step one. So step one, the dividends to the preferred stockholders is $32,900. So not only do they get caught up in their dividends and arrears, they also get the dividends to which they're entitled for 2013. Okay, so how much do we have left now? We have $32,900 left. Okay, so we move on to step two, which we determined was $65,800. Remember this? Unfortunately, we don't have enough left to cover that amount, so the common stockholders just receive the $32,900. Even though this is what we calculated, there's just not enough money, so they just get whatever's left. Common stock is not cumulative, so the common stockholders aren't entitled to any more than whatever's left. And at this point, we don't have any dividends in arrears. We took care of this. Okay, so 2014. In 2014, no dividends to preferred or common stockholders, but just like in 2011, we now have, again, $32,900 dividends in arrears. There's no money to give out. Okay, 2015, we have 151,000 dividends to pay. So first, we pay the preferred stockholders the dividends in arrears, which is $32,900. Okay, so we've taken care of that. Now we move on to step one. So step one, in 2015, we give our preferred stockholders $32,900. Okay, so step two, we can give our, we should be keeping track of how much we're giving away, huh? Can't give away more than actually was declared. So we started out with $151,000. If we subtract what we're giving to the preferred stockholders for dividends and arrears, subtract what they're entitled to receive in 2015, and we're now in step 2, which we had calculated earlier for the common stockholders of $65,800. Let's see if we have anything left. Okay. If you were to enter that into your calculator, you'd get 19,400. Okay, so at this point, we still have something left. This is step 1, step 2. Now we move to step 3, and we determine the par value of preferred and common stock if the preferred stock is participating. In this situation, the preferred stock is non-participating, so all of the remaining dividend goes to the common stockholders. Okay, so the common stockholders get, not only do they get $65,800, they also get the remaining $19,400. So the totals, I'm just going to erase some of this down here. In 2015, we'll do some grand totals here. 2015, the preferred stockholders get a total of $65,800, and the common stockholders get a total of $85,200. Okay? Now we have situation 3. The preferred stock is cumulative and fully participating. And as you might have guessed, this is the most complicated situation. So, 2011. No dividends to preferred or common stockholders, but since the preferred stock is cumulative, we have our 32,900 dividends in arrears. Okay, 2012. We have 32,900 dividends to pay. The first thing that happens, as I'm sure you know by now, is that preferred stockholders are paid the dividends in arrears. This right here. So we pay them that. Now we can start with step 1. Okay, I'm erasing this just to emphasize a point. We pay the dividends in arrears. Now we start with step 1, and step 1 is to pay the preferred stockholders what they're entitled, but since there's nothing left, we have, again, dividends in arrears for 2012. And there's nothing left in 2012 for the common stockholders. Okay, 2013. We have 98,700 dividends to pay. So, first we pay the dividends in arrears. Okay. So let's see what we have left to work with. Okay, so let's to allocate this remaining amount here, we go through the steps again. Step 1, the dividends to preferred stockholders is 32,900. In addition to paying the dividends in arrears, so they get a grand total of 65,800 there. So let's take that amount out. How much do we have left? Let's see. We have another 32,900. We go to step 2. We had determined that step 2 was 65,800, but again, we don't have that much, so we just give the common stockholders everything that's left. Okay, and now we are out of money and done with 2013. Okay, so 2014. No dividends to preferred or common stockholders, but just like 2011, We now have 32,900 dividends in arrears. Nobody's paid anything. Okay, 2015. 2015, we have 151,000 dividends to pay. Okay, so first we pay the preferred stockholders the dividends in arrears from 2014. Okay, took care of that. Now we move to step 1, where we pay the preferred stockholders their dividends for 2015. And now we move to step 2, which we had already calculated was 65,800. Remember, we made these calculations back in scenario 1. So sorry I don't have enough room to write it on this little screen here. I can't make this screen any bigger. So how much do we have left? If we start out with 151, we're giving 32,900 to the preferred for dividends and arrears, 32,900 to preferred for 2015, and 65,800 to common for 2015. And we have 19,400 left. Now we move on to step number 3. So step 3 is to determine the par value of preferred and common stock if the preferred stock is participating. Now in the last 2 scenarios, the preferred stock was non-participating, so we were able to stop there, but in this scenario, the preferred stock is participating. So we have to figure out the par values. I'm going to just erase some of this up here. I'm just going to move these numbers up a little bit so I have some more room to write. The 65,800 is just the sum of those 2 numbers. I'm just combining it. Nothing fancy. No tricks. Okay. So I have to find out the total par values. So we've got preferred. Total par value is the total number of preferred shares, 32,500 times 14, and that equals 329,000. Total par value of the common is the total number of common shares times the par value of the common shares, which is equal to 658,000. To find the grand total par value, add those two, and we get 987,000. Okay, so that was step 3. So step 4 is to make these into ratios and multiply each ratio by the amount remaining to the amount of dividends left to distribute. Okay, so preferred. The preferred ratio is going to be the par value of preferred over the total par value. So 329 over 987. Now you can just throw away these zeros. That's just some math. Okay, I'm going to multiply that ratio by the amount that I have left to distribute. 19,400. So if you plug that into the calculator, you get 6466 and 67 cents, which you could just round this. Let's just round it. If you do these calculations in MyLab, it'll probably have you round it anyways. Okay, and then common, multiply the ratio for the common stockholders, which is the common par value of 658 divided by the total, 987 times 19,400. And I'm going to plug that into my calculator and round it, so I get 12,933. So this is how I distribute the remainder, because the preferred stock was participating. So the preferred stockholders get 6,467 of the remainder. The common stockholders get 12,933 of the remainder. So to get our grand totals, we just add them together. 39367 and 78733. Now if I were to add these two numbers, it would equal 151,000, which is how much I had to distribute. Okay, so that wraps up Learning Unit 3, and we won't be covering Learning Unit 4. As always, let me know if you still have any questions or have any trouble with any of this material.